Welcome to the deep dive. Our mission here, as always, is to take a whole stack of sources, articles, research, data, and really pull out the insights that help you get up to speed instantly. Today, we're doing a deep dive into, well, this single kind of silent force. It's a mechanism that, probably more than any other, really dictates how wealth gets created over a lifetime. We're looking at a concept and gets thrown around a lot, maybe in Finance 101, but honestly, most people don't truly internalize it or, really maximize it, especially if you're just starting out on your financial journey. So our goal today is specific. We're breaking down compound interest, and we're zeroing in on this idea. It's almost revolutionary that time is the real asset, the
Yeah.
one you can't replace, the amount you start with. Yeah, it's important, sure, but it almost always takes a backseat to just how long you stick with it. It's a natural instinct, isn't it? To think prosperity comes from just grinding harder, earning more, working more hours, launching another side hustle. Most of us are basically conditioned to chase that bigger paycheck right now.
hmm That immediate reward.
Exactly. But the sources we looked at, they really challenge this idea head on. They suggest the real secret, maybe to generational wealth even, isn't just working harder. It's more about setting up the right system.
And then letting time do the heavy lifting.
Right. Stepping back and letting it work. This thing has been described as a quiet force in finance that turns tiny, consistent savings into results that can literally rewrite life trajectories.
It sounds dramatic, but the math backs it up.
It's apparently so fundamental, so powerful that Einstein,
Wow.
Albert Einstein, reportedly called it the eighth wonder of the world.
That's the famous quote, yeah.
And that wonder, it's compound interest. We promise you, by the end of this deep dive, getting this math, it doesn't just change how you look at your money. It really changes how you value your own time right now, today.
Yeah, that shift in perspective is crucial, and it really frames what we're going to do here. We're not just throwing definitions at you. We want to give you a roadmap. We're going to walk through the precise mechanics, analyze the cold, hard math of its growth curve, and maybe the most important part, talk about the mindset, the long-term thinking. You absolutely need to harness this overwhelming power. So first things first, we need to make sure everyone's on the same page. The power of compounding, it gets misunderstood because people mix it up with its much weaker cousin, simple interest. So step one is just unpacking the definition, making sure we really get what that compound part means and how it physically separates that, exponential growth from just plain old linear growth.
Okay, let's unpack this. We've called it the eighth wonder. Sounds almost mythical, but what is it? Like, in the simplest terms for someone totally new to this.
At its absolute core, it's like a self-feeding loop. Compound interest means your initial money earns interest. Okay,
Yeah.
simple enough. But then, and this is the critical bit, that interest immediately becomes part of your main pot, your principal, which means it starts earning interest too.
Ah, okay, so it's money making money.
Right. Which then makes more money, which hires more money to work for you. It's this ever-expanding feedback loop.
Okay, so let's use that basic example from the sources. Say you start with a hypothetical $100, and let's assume a 10% growth rate just for easy math. The first few years, they look pretty straightforward, almost deceptively so.
They really do. Year one, okay, you make $10. Your total is $110. Now, if this was simple interest, the calculation would always just look back at that original $100.
Right,
You just earn $10
right.
every single year. So year two would be $120, year three, $130, just adding $10 each time. That's slow, predictable, linear.
Okay.
But with compounding, year two is where it changes. You now earn 10%, not on the original $100.
But on the $110.
Exactly. So you earn $11 in interest that year. That's $1 more than the year before. Your total's now $121. And that extra $1 earned on the interest from year one, that's like the first little seed of the exponential growth. That's the moment the curve starts to bend upwards away from that straight line.
And that bend, it picks up speed pretty fast, doesn't it? Because year three, now you're earning 10% on $121. So that's what, $12.10 in interest, brings the total to $133.41. And then year four, you hit $146.41. That difference, the extra $6.41 compared to what simple interest would give you, $140, that gap just gets wider and wider the longer it goes on.
That progression, that accelerating gap, that's what we really need to focus on. It shows how the growth just stops being linear pretty quickly. In the early years, yeah, it seems like the money you put in is doing most of the work. But the longer you stretch that timeline, the more of the total gain actually comes from interest earned on previous interest. That's what the sources mean when they say that's time doing its job.
Okay, I want to dig into the mechanics just a bit more. We talk about this growth being exponential,
Mhm.
that curve that starts shallow then shoots up. What are the actual mechanical things that speed up that curve beyond just getting interest once a year?
Oh, that's a great point. A really good technical question. And it brings up two important uh, related ideas: how often it compounds and the actual rate of return.
Okay.
So first, compounding frequency. We often use annual compounding in examples because it's simple, right? $110 after year one, $121 after year two. But in the real world, lots of accounts compound much more often, maybe daily, sometimes even continuously.
Daily, so 365 times a year.
Yeah. If your account compounds daily, your interest gets calculated and added back to the principal every single day. This means the tiny bit of interest you earn today, it starts earning its own interest tomorrow.
Wow.
Now, the difference between daily and annual compounding might look tiny in year one, almost negligible.
Right, seems small.
But stretch that over 40 years, that small, continuous acceleration. It actually magnifies the end result quite noticeably. It basically makes sure those tiny employees we mentioned earlier, they literally never take a break.
So, okay, even if the advertised annual rate is 8%, because the interest is getting added back in constantly, the actual yield, the APY, is a tiny bit higher than the APR. It's just a small optimization, but like you said, over decades, small things become huge and compound.
That's exactly. Small optimizations over long periods become massive. And the second factor is the rate of return itself. This trips up a lot of beginners.
How so?
Well, they get focused on finding some magic investment that gets them like 20% a year. They chase really high returns.
Yeah, you hear about that.
But our sources really emphasize that consistency and a reasonable return, say 8% or maybe 10%, something the market has historically provided if you sustain that over 40 years. It absolutely crushes trying to jump in and out, chasing high returns sporadically. Consistency gives you the duration, and duration is
Yeah.
the real accelerator.
Okay, that makes sense. This is where that visual analogy from the sources, the snowball rolling down the hill, really starts to click for me.
It's basically the perfect picture for this.
Yeah.
Imagine starting with a tiny snowball at the top of a really long hill.
Okay.
Maybe after 5 years, let's say. The snowball is still pretty small. Most of its size came from the snow you packed on yourself, your contributions. It's rolling, but kind of slowly.
Mm-hmm.
But as it keeps rolling down that super long slope, maybe the next 35 years, every time it turns over, it picks up a layer of snow. That's the interest.
Right.
But now, because its circumference is slightly bigger, the next rotation picks up proportionally more snow. It gets heavier, it has more momentum, its surface area is bigger, and that extra weight makes it roll faster, picking up even more snow on the next turn.
So the growth isn't just adding the same amount each time.
Exactly. It's not additive, it's multiplicative. It's not picking up, 1 cup of snow every rotation. The acceleration is built into the snowball's increasing size itself.
That's the fundamental difference. Linear versus exponential wealth building. Hashtag tag two, the dominance of time over capital.
And that snowball analogy, it leads us straight into really the core argument of this whole deep dive.
Yeah, this idea that our bias, our cultural default, and definitely the bias for most beginners, is to prioritize capital. We think, I need a big pile of money to get started. The focus is just on the dollar amount.
And that focus, well, the sources argue pretty strongly it's misplaced. They really hammer home this crucial kind of counterintuitive idea. The priority has to be time.
Time.
Capital. You can always find ways to get more, work extra hours, maybe get a raise, find another income stream. It's replaceable, ultimately. But time,
Yeah.
especially at the time you had in your 20s, maybe your 30s, it's absolutely finite. You can't earn it back. It's non-renewable.
Very on, it's gone. It's gone.
Exactly. The leverage that time gives you is just so immense.
Yeah.
We have to move past the analogy now and look at the cold, hard numbers, the actual cost of waiting.
Okay, let's set up that key comparison. The one that shows honestly, the financial devastation that can come from waiting just 10 years to start investing.
Right. So we'll use the scenario from the forces. Someone invests $100 every single month consistently, and they achieve let's say, a market average 8% annual return over their working life.
Okay, so $100 a month, 8% return.
Yeah.
Pretty standard, consistent saving habit. And importantly, the rate of return is the same in both cases we'll look at, and the monthly amount is the same. The only thing changing is the start date.
Exactly. That's the key variable. Okay, scenario A. The early starter, let's say they begin at age 25. They get 40 years of continuous compounding. By the time they hit age 65, the approximate total is $310,000.
Wow, okay. From $100 a month.
Yeah. And think about this. The total amount they put in, their principal, was $100 times 12 months times 40 years. That's $48,000.
So over $260,000 of that $310,000 is just growth.
Pure growth, Interest on interest on interest. Now, look at scenario B, the late starter. This person waits. They don't start until age 35, just a 10-year delay. They still do the $100 a month religiously. They still get the same 8% return.
Okay.
But by age 65, they've only had 30 years for compounding to work. Despite putting in the exact same monthly effort for those 30 years,
Yeah.
their approximate total is only $140,000.
Wait, only $140,000?
That's less than half.
Less than half. The difference is 10 years of waiting at the beginning.
Yeah.
The final wealth is slashed. The loss is over $170,000.
That's genuinely shocking. $170,000 lost just from waiting 10 years. But hold on, I have to push back a bit here, playing devil's advocate like a beginner might.
Sure.
If they waited 10 years, okay, they missed 120 months of putting in $100. That's $12,000 of their own money they didn't contribute, right?
Correct. $12,000 in missed contributions.
So if they only missed putting in $12,000, how on earth did they end up $170,000 behind? Doesn't that suggest the capital does still matter a lot, especially if maybe you could put in a bigger lump sum later to catch up?
Ah, that is the perfect question. And it proves the point beautifully. Our brains are just wired for linear thinking, not exponential. You're absolutely right. They only missed contributing $12,000. But the final difference is $170,000, the huge gap. It shows the loss wasn't really the $12,000 principal. The loss was the compounding power that first $12,000 would have generated over 4 full decades.
Okay.
Let's think about where that $170,000 difference really piled up. Those first 10 years for the early starter, they're absolutely critical. That's the period where the interest starts earning interest, and that interest earns more interest. All growing, potentially tax-free, establishing this much larger base for the later, faster growth phases.
So that very first $12,000 the early starter put in, that was basically the most valuable money they ever invested.
Mathematically, yeah, you could definitely argue that. Because those initial dollars had the longest possible runway, 40 years to multiply and multiply again. For the late starter, their first contributions only had 30 years to work. And since the growth is exponential, the real explosion in wealth happens in those last, say, 10 or 15 years.
Right, the steep part of the curve.
Exactly. So the late starter's account balance when they're, say, 55 years old, 10 years from retirement, is way, way smaller than the early starter's account at age 55. This means in that final, really powerful decade, age 55 to 65, the early starter is compounding interest on a base that might already be $150,000 or more. While the late starter, they're compounding on maybe only $80,000. The difference in the growth during just those final 10 years alone could easily be over $100,000.
Wow. It really is like trying to start that snowball just 10 feet from the bottom of the hill versus starting way up at the peak. The late starter snowball just never got big enough early on to gather that critical high-speed momentum later.
And there's a simple tool we can use to kind of visualize this acceleration, the rule of 72. Heard of that?
Vaguely, yeah. Remind me.
It's a quick mental shortcut to estimate how long it takes for an investment to double in value. You just divide 72 by your annual rate of return.
Okay.
So at our 8% rate, 72 divided by 8 equals 9.
So the money doubles roughly every 9 years at 8%.
Roughly, yeah. It's an estimate, but it's close enough. Now, think about the early starter, 40 years. How many doublings is that? About 4, maybe pushing 5 doublings in that time.
Okay, 4 or 5 times it doubles.
Now, the late starter, only 30 years. They only get maybe 3, perhaps 4 doublings. That one extra doubling period makes a colossal difference. Think about it. If your account hits $150,000 just before that final 9-year doubling period, it grows to $300,000.
Yeah.
But if the late starter's account is only at $80,000 before their final doubling, it only grows to $160,000. That last doubling is where the massive leverage really shows up.
And the late starter misses out on the most powerful one because their base wasn't big enough. That's the tangible cost of waiting. You just cannot buy back the time needed for those first few compounding cycles, which set the stage for that huge final growth spurt. #Tech3, the mindset of long-term wealth.
The second we grasp that, waiting 10 years costs you potentially 10 times or more the actual money you didn't invest, the conversation has to shift. It moves from just math to, well, psychology, our conditioning.
Yeah, if the math is so stark, so clear, why do people still delay? It seems it must come down entirely to how we perceive time, how we value it.
It really is that shift from the sort of short-term view with a consumer mindset, maybe to the long-term systemic view, the wealth builder mentality. Our sources really stress this. People who successfully harness compound wealth, they just operate on a different clock.
How so?
They're not thinking in days or weeks, not even really quarters. They think in decades. They understand intuitively or explicitly that those first few years of returns, they're going to look tiny. negligible almost. But they see those first 5, 10 years as just necessary foundation work. It's like the cost of admission to get into the exponential party later on.
So while the amateur investor, maybe they're checking their app every day, asking, how much did I make this month? Hoping for a quick win, get rich quick.
Right. The wealth builder is asking a totally different question. The only one that really matters for compounding. How much time can I give this system, this investment, to grow over the next 10, 20, 40 years? Their focus isn't on hitting it big today. It's on maximizing the duration, maximizing the consistency.
This sounds a lot like behavioral economics, right? That concept of hyperbolic discounting. We value immediate rewards way more than future ones.
Absolutely. We discount future returns heavily. $100 in your hand today just feels much more real, more valuable emotionally than the promise of $1,000 in 30 years.
Yeah.
Even if mathematically the $1,000 is obviously the better deal.
Yeah.
And that's the struggle for beginners. The reward for their discipline, their saving, it feels so far off. It's abstract. So they prioritize satisfying the immediate urge, the impulse buy, the nice dinner out, the vacation over that tiny, almost invisible growth happening in their investment account.
Yeah.
Compounding demands that you deliberately fight that short-term bias. You have to consciously reject it.
So what's the rule then?
The foundational rule, the one you have to internalize is, compound interest rewards patience, not perfection.
Patience, not perfection. I like that.
You don't need to perfectly time the market dips and peaks. That's impossible anyway. What you need is to maintain market presence. Just stay in the game. And this is where that systematic approach, dollar cost averaging or the DCA, becomes so powerful.
Okay, let's quickly define DCA because it sounds like the practical way to live out this consistency mindset.
Yeah, DCA is super simple conceptually. It just means investing a fixed amount of money, like that $100 a month, at regular intervals. Same time every month or every week, whatever it is. And crucially, you do it regardless of what the market's doing. Market's up. You invest $100. Market's down. You invest $100.
Set emotion out of it.
Completely. It eliminates that urge to try and guess the bottom or sell at the top, which, let's be honest, is a fool's errand for most people, even professionals. You just commit to buying shares regularly. Sometimes you'll buy when prices are high, sure. Other times you'll buy when they're low, effectively getting more shares for your $100. Over the long haul, your average cost per share gets smoothed out. And the most important part, you never stop the compounding process. You're always in.
Okay.
This brings us right back to that tiny employee metaphor we touched on. Every single dollar you invest early on, it's like hiring a tiny, tireless employee. That employee works 24/7, never asks for a vacation, never complains, and quietly reinvests its own earnings to hire more employees. The wealth builder understands their main job isn't necessarily to earn more money themselves, but to consistently hire more of these tiny dollar employees, and crucially, never fire them early by pulling the money out.
So the mindset is all about building systems, not just running sprints. It means prioritizing things like automation, deliberately ignoring the day-to-day noise from financial news, and just consistently contributing. Knowing the real leveraged payoff is way down the road. That takes some serious financial maturity, doesn't it?
It absolutely does. It's a different way of thinking about money and time altogether. Hashtag TEDCAPE4, the mathematical proof of exponential effect. Okay, so let's bring the numbers back in. We need to really hammer home the mathematical proof, show how powerful this exponential effect really is. And this connects the dominance of time with the impact of consistency and, importantly, the size of your contributions.
Right, we set the baseline earlier. That $100 a month, starting at 25, 40 years at 8%, gets you around $310,000. That's the result when you max out the time component.
Exactly. Max time, consistent, small amount.
But now let's see what happens when you combine that maximum time with putting in more money. Most people, thinking linearly might guess, okay, double the investment, maybe you roughly double the outcome.
That's the intuitive guess, right? Double the input, double the output.
Yeah, but because it's compounding, because it's exponential, the result gets magnified way beyond that, doesn't it?
Exponential growth just laughs at simple arithmetic. Let's run the parallel numbers. If you double that investment, you go from $100 a month to $200 a month, but you keep the exact same 40-year time frame and the same 8% return.
God.
The result isn't just double $310,000. It's often substantially more. The numbers show you'd end up surpassing $620,000 plus less.
Whoa. Okay, so hold on. You doubled the amount you put in yourself, right? Your total principal contribution went from $48,000 to $96,000 over the 40 years.
Correct. An extra $48,000 out of pocket over 4 decades.
But the amount of growth generated the interest on interest didn't just double from $260K to $520K. It went much higher, resulting in like over $500,000 just from the compounding gains alone. How does that work?
It's profound, really. It's the multiplication effect. You're
Yeah.
applying that same powerful exponential growth curve, but you're applying it to a larger starting principle and maintaining it for that entire long duration.
Okay.
Let's go back to the snowball. With $200 a month, you haven't just committed to the same 40-year roll down the hill. You've committed to doing it with a snowball that is essentially twice as heavy from day one.
Right. Bigger base.
Because that initial principle, the base of the snowball, is larger. The actual dollar amount of interest earned in year one is larger, 16 versus $8 roughly, on the first month's contribution averaged out. That larger year one interest then gets compounded in year two, year three, and so on. You're compounding larger amounts right from the beginning. Over 40 years, that difference creates this massive amplification effect.
So in simpler terms, because you started with more money each month, the interest curve itself starts from a higher point on the graph. But since that curve bends upwards exponentially, the entire trajectory, the whole path of your wealth, is lifted significantly higher compared to the $100 baseline.
That's a perfect way to put it. The whole curve shifts upwards, and the exponential nature widens that gap dramatically over time. And this is incredibly motivating, I think, because it shows that every small increase you can manage in your consistent savings, maybe going from skipping one takeout meal a week to skipping two and investing the difference,
Yeah.
that small change creates this huge leveraged effect over the long term. It tells you that these little incremental improvements in your savings habits,
Yeah.
they get highly rewarded by the compounding machine.
That's powerful. Okay. Let's also quickly touch on the interest rate itself. How does that interact with the time factor over, say, that same 40 years? If someone starts at 25, does the $100 a month, but maybe they're super conservative and only get a 5% return instead of 8%, what does that look like?
Okay, yeah, good comparison. A 5% return might be typical for, say, very conservative bond-heavy funds. If you run the numbers $100 a month, 40 years, 5% return, the total is still pretty respectable. It's around $150,000.
Okay, 150K versus $310 at 8%.
Right. Now compare them. That 3% difference in the annual rate of return, it resulted in more than double the final wealth.
Wow.
So this comparison really highlights that while time is definitely the dominant factor, the rate of return is still hugely important. Why? Because a higher rate makes that exponential curve bend upwards even faster. It accelerates the acceleration, if that makes sense.
Yeah, it steepens the curve.
It absolutely does. So it really underscores the importance of, step two in our action plan later, picking an investment vehicle that's designed to capture a reasonable, historically proven growth rate,
Yeah.
not just sitting in cash or something, earning next to nothing.
Okay, so putting it all together, the goal is always to try and maximize all three levers, right? Time, which is the most critical, consistency, probably the second most important, and you achieve that through automation. And then rate, which is vital for really juicing the leverage that time and consistency provide.
Precisely. That's the trifecta. Compound interest validates consistency above all, but it requires that combination. Small, sustained habits, multiplied by a decades-long commitment, amplified by a decent rate of return, to create those truly massive results.
Okay, we've gone from the concept, the why, to the mathematical proof. Now let's get really practical, the implementation phase. If this force is so powerful, we need a clear, simple roadmap, especially for beginners. How do you actually start? What vehicle do you use?
Yeah, let's make it concrete.
And the really great thing here, according to the sources, is that you don't need to be some kind of Wall Street guru or day trading expert to harness this. Not at all.
Absolutely not.
It just requires following a few straightforward, highly effective steps. And they're all designed, really, to maximize that time factor and minimize costs and complexity.
Exactly. We've kind of distilled it down from the sources into 5 key steps.
Yeah.
They're designed to remove the hurdles, automate as much as possible, and just give your money the longest possible runway for that compounding magic to happen.
Yeah.
Okay, step 1, open an investment account. Simple enough, right? You need a place, a container to hold the money. You can use common, trusted platforms, Fidelity, Vanguard, Schwab, maybe a local app you trust, plenty of good options. But, and this is a critical addition for maximizing compounding, prioritize tax-advantaged accounts first.
Tax advantaged? Like
Like a Roth IRA, or maybe a 401k if your employer offers one, or similar accounts depending on your country.
okay, why is the tax advantage part so important for compounding specifically?
Well, think about how compounding works. It's those internal returns, the
Yeah.
interest and dividends generating their own returns.
Yep.
Now, what happens if those internal gains get taxed every single year, which is what happens in a standard regular brokerage account? You're basically letting the government skim a little bit off your snowball's growth every year. You're removing mass.
Ah, okay. Slowing it down.
Exactly. But with something like a Roth IRA, for example, in the U.S. system, your money grows and compounds potentially completely tax-free. You pay tax on the money going in, but then all the growth, all the dividends, all the compounding for decades,
Hmm.
it's sheltered from taxes. You don't pay tax when you take it out in retirement under the current rules. This is another massive layer of leverage. If taxes aren't taking a slice every year, that slice stays in the account, working for you, compounding right alongside the rest of your money. You're essentially compounding the tax savings too.
That's huge. Okay, so prioritize those accounts. Get the container open. Step one, what goes inside the container?
Right. That brings us to step 2. Pick a simple ETF.
Okay, ETF. Let's quickly break that down. Exchange traded fund.
Yep. Think of an ETS as basically a basket of stocks. Instead of you having to buy individual shares of Apple, then Microsoft, then Google, then 500 others,
Mm.
you buy just one share of the ETF. And that single share instantly gives you tiny fractional ownership in hundreds or even thousands of different companies all at once.
So instant diversification.
Exactly. It spreads out your risk. If one company in the basket has a terrible year, it doesn't sink your whole investment. You're betting on the overall market, not just one horse.
The sources mentioned a few specific tickers, VOO, VTI, SEHD. For a beginner, what's the quick difference there? Why those?
Good question. They're suggested mainly because they're very low cost, they're highly diversified, and they track broad sections of the market. VOO, for example, tracks the S&P 500 index. That's the 500 largest public companies in the U.S. Buying VOO is essentially making a long-term bet on the overall health and growth of the American economy.
Okay.
VTI is even broader. It tracks the entire U.S. stock market, large, mid-sized, small companies, thousands of them, even more diversification.
Got it. And SEHD.
SEHD is a bit different. It focuses specifically on companies that have a strong history of paying dividends. This can be appealing, especially later on, but for a beginner just focused on maximizing that long-term growth and time leverage. VOO or VTI are often cited as excellent, super simple starting points. They require basically zero ongoing decision-making from you, and historically, they've delivered those kinds of average annual returns, in the 8–10% range over very long periods, which lines up with our examples. Low cost, broad market, set it and forget it.
Perfect. Okay, step 3.
Step 3, invest automatically. This one. We really cannot overstate how important this is from a behavioral standpoint.
Right, linking back to the mindset.
Absolutely. Set up recurring automatic investments, whether it's $10 a week, $100 a month, $50 every payday, whatever fits your budget. Automate the transfer from your bank account to your investment account. Ideally, set it up for the day after you get paid.
Pay yourself first.
Pay your future self first. The sources strongly suggest automation is the engine that drives consistency. Why? Because it takes you and your daily emotions and willpower out of the equation.
Yeah, you don't have to decide to invest each month.
Exactly. The money just moves. You don't have a chance to second guess it or spend it on something else. It ensures you stick to that dollar cost averaging plan we talked about month after month, year after year.
Okay, that seems like the absolute non-negotiable link between the mindset piece and the actual math working out. Now, what about step 4? This sounds crucial for supercharging the compounding.
It is. Step 4, reinvest dividends. This is often the missing piece, the thing beginners don't realize is it's so critical.
Okay, explain dividends again quickly.
Dividends are just portions of a company's profits that they decide to pay out directly to their shareholders, usually quarterly. So if you own shares in VOO, the ETF collects dividends from all those 500 companies and passes them through to you.
Okay, so I get a little cash payment.
Right. Now, what do you do with that cash? If you just let your brokerage account pay those dividends out to your bank account, you're effectively breaking the compounding cycle. You're shifting back towards simple interest thinking. You're taking your earnings out and consuming them, or at least not putting them back to work immediately.
I see.
But if you set your account to automatically reinvest those dividends, which most platforms let you do with a simple checkbox, what happens? That dividend money is immediately used to buy more shares of VOO or VTI or whatever you hold, even fractional shares.
So the interest automatically buys more principal.
Precisely. You're ensuring that your earnings, your interest, are immediately put back into the pot to start generating their own earnings. Go back to the tiny employees. Your original shares employees earned a dividend, a payment. By reinvesting, you're forcing that payment to instantly go out and hire more tiny employees who start working for you that very same day. This feature ensures your money is truly compounding continuously, often without you even having to add new money yourself. It accelerates the snowball's growth internally.
That makes so much sense. Okay, crucial step and the final one.
Step 5, give it time. This sounds simple, but it's often the hardest. It requires patience, real long-term patience, and frankly, ironclad discipline.
Because the market doesn't just go straight up.
Exactly. Markets will drop. They always have. They always will. You'll see scary headlines. Your account value might fall 20%, maybe even 30% or more in a bad year. It happens. When this happens, you have to let the compounding process keep working. Do not panic and sell everything. The true long-term compounder actually views those market drops differently.
How?
As an opportunity, because their automated investment plan, step 3, is still running. That same $100 is now buying more shares at the lower prices. They're effectively buying low, systematically, without even trying to time it. You have to trust the process and stay the course.
Wow. Okay, that is a simple plan, but incredibly comprehensive when you put all 5 steps together. Minimal financial jargon needed, maximum focus on consistency, and just immense patience required. The big takeaway seems to be, you don't need to predict the market's wiggles, you just need to guarantee you're participating consistently in its long-term upward trend.
That's the essence of it. Participate, don't predict.
All right, so we've got the math, it works, we've got a clear, actionable plan, seems straightforward. But we have to tackle the elephant in the room, the major failure point. If compound interest really is this 8th wonder, and the steps are actually pretty simple, why don't more people achieve that kind of massive compound growth? Why do the vast majority, frankly, never get there?
Yeah, this is the reality check moment, and the answer, which comes through loud and clear in the sources, is, well, it's brutally simple. They quit.
They just stop.
They stop. They stop contributing, or they panic during a downturn and sell everything. They basically jump off the ride before the compounding really gets interesting, as one source put it.
Before the exponential curve really takes up.
Exactly. This is a huge psychological hurdle. This is what separates the people who eventually see those amazing results from the ones who just drop out along the way. Think about it from the beginner's perspective. When you first start, the growth feels incredibly slow, painfully slow sometimes.
Yeah.
You're putting in your $100 every month, diligently. And after the whole first year, you look at your statement, and maybe the total interest earned is, I don't know, $96 or something.
Right. Seems tiny.
It feels insignificant compared to the $1,200 you actually saved and put in yourself. That feeling, that lack of immediate reward, it breeds doubt. It leads to boredom, frustration even. You start thinking, is this even worth it?
We called this the boring middle earlier. You're putting in the effort, maybe the market is flat or even down slightly, so your total account value barely moves. But you still have to make that sacrifice, find that $100 every single month. It feels like work with no payoff.
That's a perfect description.
Yeah.
The boring middle. The sources are really clear. In the first 5 to 10 years, it feels slow, almost boring. And why? Because like we said, in those early years, the money you contribute, your principal, is still the main thing driving the account growth. Your $1,200 contribution over the year totally dwarfs the $96 in interest it generated. You're still mostly in the phase of just packing the snowball together yourself. It hasn't started rolling fast enough to pick up significant snow on its own yet.
Okay.
That explosion phase, the point where the growth from interest alone starts to equal or even exceed the new money you're putting in each year, that only happens much later. Usually you need a decade, maybe even more, of strict, unwavering consistency. For that person doing $100 a month at 8%, that inflection point where the account starts adding more from interest than from their deposits typically doesn't hit until somewhere around year 18 or maybe even year 20.
18 to 20 years. Wow. So basically the first almost 2 decades are just laying the foundation.
Pretty much. They're crucial, but they're the slow burn. And if someone quits in year 7, maybe because they got bored or they needed the money for something unexpected or they just lost faith, they never get to experience year 19 or year 20, where the money truly starts working harder than they are.
They essentially forfeit all that time leverage they worked, even for just 7 years. So hard to build up.
They do. And this leads directly to what the sources identify as the single biggest mistake beginners make, starting and stopping. The inconsistency kills the compounding. Maybe someone gets a bonus, invests $5,000 in year 1. Feels great. But then life happens. They stop contributing for the next 3 years. They might feel like they got a good head start.
Yeah, it seems like a big chunk up front.
But that sporadic intensity, it's actually devastating compared to someone who just put in a simple, steady $1,200 100 month every single year for those same 4 years without fail.
Why? Because the consistent person maintained that unbroken time horizon. They kept the snowball rolling, even if slowly.
Exactly. They never let the momentum die. The person who started strong, but then stopped, They effectively let the snowball freeze in place for 3 years. All that potential compounding of the contributions they didn't make in years 2, 3, and 4, gone forever.
Yeah.
And the momentum on the initial $5 case slowed way down.
Okay.
So the core message here, the discipline needed, it has to be like a mantra. Consistency beats intensity. Every single time. Short bursts of saving really hard, followed by periods of quitting or pulling money out, that completely negates the power of compounding. It needs an unbroken runway to reach its full potential. It means, frankly, having the stomach to sit through the bad years, keep automating those contributions even when it feels pointless, and just trusting the long-term math. The system rewards the people who are simply too stubborn to quit. #Tech7. The emotional side of compounding.
Okay, we've hit the math hard, we've got the practical steps. But it feels like we keep coming back to this idea that compound interest isn't just a formula on a spreadsheet.
Not at all.
As the sources really point out, it's almost like a profound lesson in human behavior, in emotional discipline.
It really is. It's a philosophy, in
Yeah.
a way. It teaches patience. It forces you to develop long-term thinking. It makes you shift your focus, sometimes uncomfortably, away from immediate gratification towards, well, future well-being,
Yeah.
future utility.
It asks you to make these small, often barely noticeable sacrifices today,
Right.
knowing that those sacrifices aren't just savings in the traditional sense. They're actually highly leveraged investments in your future self.
And it connects financial success directly to very personal traits like self-control, discipline, consistency. It's all about the cumulative effect of tiny decisions,
Yeah.
repeated over and over and over for decades. We often think about big financial decisions, buying a house, changing jobs. But compound interest is really fueled by the micro decisions, the everyday choices.
Like what?
Like you're standing in line, you see something you want, an impulse buy. Maybe it's $30, maybe $50, something non-essential.
Right.
In that moment, you're not just deciding whether to spend $50 on that thing. You're also implicitly deciding whether that same $50 gets the chance to work for you to compound for the next 30 or 40 years.
And we already know, based on our earlier math, that $50 invested today at, say, 8%, it doesn't just stay $50. Over 30 years, it could easily grow to be worth closer to $500, maybe more, purely through compounding.
Exactly. So that tiny act, skipping the impulse purchase, maybe deciding to invest an extra $10 or $20 this week instead of spending it, it's like planting a seed with this incredible leveraged growth potential baked into it. Every time you do that, it's like casting a small vote for your future self.
That's a great way to frame it. Little votes for consistency.
And those little votes, they add up. They compound, just like the money does. They build into something financially much greater than you might imagine initially. And maybe just as importantly, psychologically, it can become really satisfying. It gives real meaning to delaying gratification because you understand the reward for that delay isn't just linear, I saved $50. The reward is exponential. I invested $50, that could become $500.
Yeah.
And this brings us to maybe a crucial personal reflection point for anyone listening. Try focusing on future gratitude. Sounds a bit cheesy, maybe.
Go on.
When you're 65 or 70, hopefully looking at a healthy investment account that gives you options and freedom. You are absolutely not going to be thinking about or regretting skipping that one fancy dinner back when you were 30. You won't even remember it.
True.
What you will feel, overwhelmingly, is gratitude. Gratitude for the discipline your younger self showed. Gratitude for the time you gave your money to grow, starting early.
You're essentially making a pact, a long-term contract with your future self. You're using the one resource you probably have more of today than you will later, which is time.
Right, your most abundant resource now.
And you're leveraging that time to secure the resource you'll likely need most later, which is financial freedom, security, options. It shifts the burden of generating that wealth from your future, perhaps tired self, onto your present, hopefully motivated and definitely most time-rich self.
Beautifully put. That's the emotional core of why starting early matters so much. #tag outro.
Wow. This has been a really extensive deep dive. We've gone through the mechanics, the math, the mindset, the practical steps, the pitfalls, all centered on this simple yet totally profound concept. If we had to synthesize it down to one core truth about building lasting wealth, it seems to be this. It's not built overnight. It's not built through sporadic genius. It's built over decades, brick by brick, through unwavering consistency.
That's the hard thing.
And the amazing thing is, the moment you truly start with automation and reinvestment, The clock stops working against you and starts working for you. It becomes your most powerful ally. You don't need a huge pile of cash to begin. You just need some time ahead of you, a commitment to automated consistency, and frankly, the psychological discipline to stay patient, especially through those inevitable, boring, or even scary middle years.
And we absolutely have to revisit that central, almost terrifying warning just one last time, because it's that important. The longer you wait to start, the smaller your potential snowball, your potential outcome inevitably remains. That difference between starting at 25 versus 35, as we saw, is potentially hundreds of thousands of dollars. Irreversible lost opportunity. Time isn't just money. Time is the accelerator of money.
Yeah, a stark reminder. But on the flip side, the moment you do commit, you open that account, set up the automatic transfer, pick a simple broad market ETF, ensure those dividends are reinvested. That's the moment your snowball starts its journey. It begins to roll. It starts picking up that momentum, slowly at first, yes, almost invisibly. But it's rolling with this inevitable, crushing, exponential potential locked inside it, waiting for time to unleash it.
And maybe just to leave everyone with a final thought, something to chew on. We talked a lot about step 4, reinvesting dividends, and how crucial that is for maximizing the growth. The sources also hint at the ultimate end game here. Compound interest eventually can be turned into a real sustainable stream of passive income.
The dream, right.
Exactly. So we'd urge you to think about how that reinvestment mechanism is the critical bridge. It's what transforms compound growth, just making the total pile bigger, into true, self-sustaining passive income generation. Because eventually, when your account balance gets large enough, you reach a point where you can choose to stop reinvesting the dividends and instead start taking them out as income to live on without ever touching the principal base.
The snowball is big enough to throw off enough snow for you to live on.
Precisely. That transition from the accumulation phase to the distribution phase, that's the ultimate goal of financial independence for many people. And understanding how compounding enables that, that's maybe the next concept worth exploring further.
A really profound final thought. A clear destination for that long journey of consistent, patient investing. Well, if this deep dive has helped you really internalize the sheer power of compound interest, and maybe more importantly, the absolute necessity of starting early, hopefully you'll take a moment today. Think about how you can integrate these principles, these steps into your own financial life. Don't wait until next time on the deep dive. Keep that snowball rolling.